We humans, we are like this pattern recognition machines. And the more you do it, the more the patterns start to become second nature. Given that there are so many unknowns in the journey ahead for any entrepreneur, you want to find investors that not only understand it because it just logically makes sense what you're saying, but they understand it because they've walked that journey before a few times.
That was Jorge Torres, CEO and co-founder of MindsDB. Jorge and Vijay Reddy, AI start investor at Mayfield, were the first two people I interviewed for season 1. We met up at Jorge's office in San Francisco's Mission District on a rainy Friday afternoon in November 2023. We dived into pitch tactics and investor outreach, but we also spent time talking about the frameworks VCs use to evaluate zero-day investments, which red flags investors and founders both need to look out for, and how to find an investor you can partner with for the next decade, not just the next funding round. Jorge has been through the fundraising process 3 times, and Vijay is an experienced seed investor, so I was glad to talk to them both about fundraising from both sides of the table. Fund Build Scale is sponsored by Mayfield, the early-stage venture capital firm that takes a people-first approach to helping founders build iconic companies. The podcast is also sponsored by Security, pioneer of the Data Command Center, a centralized platform that enables the safe use of data and Gen AI. Vijay and Jorge, thank you very much for being here today. So today we're going to talk about fundraising from both sides of the table. Vijay, you're an experienced investor. Jorge, you have raised how many times?
3 times. Yeah.
And, we're in a hype cycle, I would say. I don't think that's a controversial opinion, which means a lot of future AI founders are probably feeling serious FOMO at the moment, I think. And I think that leads a lot of people to just, they want to pitch and get out there as quickly as they can to get their company going. So before you start fundraising, I guess, my first question for you, Vijay, it's from another early stage AI founder. What is it that really convinces you to invest in an early stage company, and what can founders do to get to that point?
So I think at a fundamental level, right? So raising funds for an AI startup is like raising funds for any startup. Keeping AI aside, when we look at the teams, I think every fund has its own metrics, which they look at. Every fund looks at it differently. For us, we start with people first philosophy. Is this someone we can back? Do they have the same values? And is this a team we want to go in bed with for like 7 to 10 years? And so that's the first item we'll look at, right? And we can talk about how we can screen for that. And second is, then we'll look at the markets, right? Others look at markets first and people next, but for us, it's always people first. And then we'll look at the markets. Is this a big and growing and a nice, attractive market to go after? And it doesn't have to be at day zero, right? Sometimes most of our investments at day zero, they're blue ocean, there's like zero TAM, but can this become a big and attractive market? So once we have those two, then we go into the specifics of that particular company. Do they have the right technology? Is it, how good is the team? How good is the opportunity? And then we dive into the product and technology, but that's more on the latter side after we clear the people and the markets filter.
What does that process look like for you as far as assessing a team? How do you approach this? What are the valences you use to kind of get in there and assess their appropriateness for this product or solving this problem?
So we invest very few deals a year, right? We're a very concentrated portfolio in the sense that every deal matters to us, so we don't spray and pray, right? For us to make a deal work, we need to make sure the team has some attributes which we look for. It's not just the founder, it's the team that can come together. Do they have the product market fit? Can they attract talent? Can the founder attract talent? Does the founder understand the technology? So there's a lot of different attributes we'll look for in a founder. And usually in the first half hour, we can get a good sense of, hey, is this person in the team someone we want to spend more time with? And when we do, we tend to dig in a little bit more, right? But for the first filter, when we do talk to them and we try to meet them in person or now with COVID, we can still do the Zoom thing, but we tend to spend a lot of time on the human filter, and then we spend more time on technology afterwards.
Jorge, from your perspective, what do you think a team needs before they start pitching, before they put a pitch deck together? What do they actually need to have figured out before they go into the market and start asking strangers for money?
Yeah, I think it's to understand that at the end is a risk decision, the one that the investors are making. And frankly speaking, the decision that as an entrepreneur, anyone should be making. It's being able to understand that you're taking a risk and then you're taking an opportunity as well. So the most ideal situation is that you are building something that has, or you're about to embark into something that has a great deal of an opportunity. And then that you've thought of all the possible risks that you can control. And therefore, when you present this to the investor, you're actually tackling the risks that are in their mind. And I think that risks for investors change over the lifespan of a company. When you're starting, you have so very little data that the risks are more about, is this group of founders capable of executing what they're kind of like about to jump into? And I think that that's something to your point, like that human assessment is the most important assessment that they can be making, because companies that die, I think that you guys have been doing this for such a long time that you know that the chances of a company not surviving because the founder is not being the right fit for the problem, for the execution, or even within them are, very important risks. So founder risk in terms of are the founders the right people for doing this? The founders being able to execute because they work well, they don't have redundancies, you can try to understand that this decision from the risk point of view, then when you pitch it, you have to kind of understand that you have that part covered as well, and be honest to yourself as a founder. Am I going to be in this company for the next 10 years? Can I dedicate sleepless nights because it's going to be hard to be here for 10, 15 years? And if the answer is yes, then you know that you can articulate this. Do I have the expertise or the talent to bring people that will bring the expertise that I don't have? So those are the things that I think is one of the buckets. But I think that before you even get to that bucket, there is something that is defined not necessarily by you as a founder, and it's more as there must be a problem that is so large, so large, that it must be obvious to you because you want to dedicate your life to this thing. But it must be obvious when you articulate it as well. It has to make sense to the people that you talk about it. What you're doing here is you're telling, look, it doesn't matter how inexperienced I may be because I'm just starting. You have to build the experience into this. But the market is so large that even if I'm not performing 100% on the solution that needs to get to the market, I will iterate fast enough, or I will have enough times to iterate that I will capture a significant percentage of this market. Yeah. So this is a market risk. If it doesn't make sense from the point of view of an investor that you're going to build a business that at least sells $100 million, then all of a sudden the market is not worthwhile the risk. So for an investor, that math seems to be very simple. And if you can answer those three things effectively at the very early stage, then not only two things are going to happen. The first one is you're going to meet investors that will definitely ride the wave with you because they will likely want to also participate in the solution of that problem. But you will be jumping into something with the right answers. I think that a lot of entrepreneurs, we jump into this thing because we want to be entrepreneurs, because it's an attractive profession to have. But not being clear about these 2 or 3 specific questions that you should ask yourself and have a very, very concise answer to, it's a mistake that many of us make. And then until you figure that out, it's going to be really hard to fundraise.
Actually, following up on that, so just tangibly, Vijay, if I was at the ideation stage and didn't have a demo and didn't have customers and only had slides and an idea to share with you, would that be enough to pitch you? Or would you want to see more concrete things you can investigate and pour over before you make a decision?
Like, I think every VC wants to see as much data they can have at any given stage to make a decision, right? The more data is good, right? So if you're late stage VC, you look at the financial metrics, you look go to market, so you have a lot more information. At the seed stage, we tend to invest a lot of our deals are at PowerPoint stage. And the question going back to Jorge is like, what are we underwriting, right? There's people risk, there's market risk, there's product risk, technology risk, go-to-market risk. So we tend to see how much we can de-risk at any given stage, and the valuation and the resources are kind of going hand in hand with the kind of like going back to the risk analogy here, right? So we tend to take less risk on the people and market because that's fundamental to what we invest in. So if a team is good, if you have a good sense of the market, those are two things we can do diligence on, right, at the earlier stages. But we're happy to take product risk, go-to-market risk. We help with idea market fit. We help with product. We help with hiring and recruiting. So those are risks we're willing to take at the seed stage. And so we are more than happy. And in fact, we would encourage founders, even if they don't have a fully structured plan, to work with us, right? And we can help shape and direct at the seed stage. And that's part of being a board member. And almost every deal we do take board seats. So we kind of enjoy that part of the journey. So we typically encourage founders to come and brainstorm with us, even if they don't have everything set in stone.
I know someone who's building now, and she doesn't even have a front end for the demo because she doesn't have a designer. So she's trying to hack it herself. But it sounds like you're saying that shouldn't be a blocker for someone as far as like they can still come to you and you'll ideate together, I suppose.
Yeah, I think for the right teams though, right? So we don't have the bandwidth. Again, there's hundreds of hackathons, there's thousands of startups. We can't spend time with every one of them. But for special teams, we call it N-of-1 teams, where you have a special sauce, which either you know a market really, really well, either you've built companies in the space before, or you're world's leading expert in that particular space. So that's how we look at N-of-1 teams. And if you're building something very unique, very special, and you have a differentiated way of going to market, that's where we would like to spend more time on, just given that there's a number of hours in a day.
Are you thinking about launching an AI startup? Mayfield's $250 million AI Start seed fund is actively searching for idea stage entrepreneurs who are working at the cognitive plumbing layer. That's models, middleware and tools, data, infrastructure, and semiconductors and systems. Mayfield has a long track record. Since its founding, the firm has been an early investor in more than 550 companies, which has led to 120 IPOs and over 225 mergers and acquisitions. If you have a fundable idea for an AI-first startup, email aistart@mayfield.com. Every business that incorporates AI has to account for data privacy, compliance, and governance. That's why security developed its Data Command Center. Instead of setting up different tools that can eat up time, money, and add complexity, Security's award-winning technology automates compliance with global privacy regulations, includes a library with more than 1,000 integrations across data systems, and identifies data risk to enable protection and control. To learn more, visit security.ai. I want to keep the conversation positive because this is a hard thing to do, starting up a company. But what are some red flags that you see at that early stage that tell you early on that this is not the right team, this is not the right person? Generally speaking, what are just the typical red flags that are an easy no?
So there's quite a few of them, right? And sometimes it's obvious, sometimes it's not obvious. So there are things which have made them successful in their own fields, which might not translate very well to being a founder, right? So to give an example, if you don't know who your buyer or persona or who you're selling to, that's an open question. That's something you can diligence before. You don't have to build a product for that. You just need to have empathy for a customer and should know what you're trying to build, right? There are many founders who really like the technology but haven't thought about the business problem. There are we call them brilliant jerks at large companies. They're extremely good at individual contribution, but that's not a good skill set to start a company. There are some founders who don't know who the competition is. And these are things which you could have done homework before. So there's a lot of this nuanced way of how, as investors, we have seen so many companies, and we tend to pick up on those if not any homework, or you're not in a good listener, right? And sometimes we meet people across different areas of the spectrum, but in most cases, we tend to look for outliers, right? So if you're brilliant at something, and if you can go build a team which is very differentiated, those are things we'll look for. So we're still looking for people who are exceptional in some category.
So flipping that a little bit, as a founder, what are some red flags that as a founder make you not want to work with an investor?
I think that now, after doing this for some time, for us, what has worked is to look for investors that have done investments that can add value because of the experience that they had before. For example, we humans, we are like this pattern recognition machines. And the more you do it, the more the patterns start to become a second nature. Given that there are so many unknowns in the journey ahead for any entrepreneur, you want to find investors that not only understand it because it just logically makes sense what you're saying, but they understand it because they've walked that journey before a few times. And this type of investor will also get very excited about what you're doing because they know it. The more an investor knows an industry, the more there's this affinity, this click that happens when you meet them. And when that click doesn't happen, you have to ask yourself, is it because there is no experience from the other side in what I'm doing? And therefore, you should be cognizant that every minute that you have in the day is a minute that you're not going to be able to take back. So every minute that you're talking to the wrong investor, you're just barking at the wrong tree. So understanding what is the people that have the experience to guide you through the challenges ahead is what you should be looking to. And therefore, when you meet people and you're just essentially realizing very quickly that they just don't have the experience on the industry that you're about to jump into or that you have been working on, then you're probably, all money is green, so people say, but you need to guarantee that the money comes with a lot of value. And that has been the trick to MindsDB. Like when we have gone fundraising, after we understood that there are investors that have done very similar investments to what you're doing, and they add incredible amounts of value. Like 30 minutes talking to them will be 6 months of you like spinning wheels. That's what you want. And when it's the opposite, it's more like, I don't really know what you're talking about, but seems like the market is moving in that direction, so I'm going to throw money this way. It's okay to add investors depending on the value that they add. They may add like network, but you don't want to make them the main investor. That's the
Yeah, unlike Vijay, most VCs are not former R&D engineers, right? But with a lot of experience technically. And so I imagine there's a lot of investor education involved with like trying to get an AI startup funded. Is that something you had to do? Like, how much did you have to work to educate investors about the value of what you're trying to produce? Or did you just find investors who understood it immediately?
I think that it only got really well for us. Like everything started to get crystal clear once we started talking to investors where we were speaking the same language. And then once you do it a few times, you learn very quickly to make that discrimination. That doesn't mean that there's other investors that don't really have the experience on their bags are not valuable. I think that you can then strategize how you build around a little bit differently. You first find these people that they're just going to add a lot of value on top of the money because of the experience that they have. And then you're going to build relationships with people that may come useful down the line. Yeah. And then when it comes to making the decision of who you bring into the round, then you pick the best of the best.
Everyone always wants to know about pitch deck how-tos and how to the magic formula, what needs to be on a certain slide, so on and so forth. But it seems like what you were saying before is that getting funding for an AI startup it's more or less the same as a startup. It's just there are some specific problems you have to solve and address and think about. So if I said, which slides are most important in an AI pitch deck, how would you answer that one?
I think it depends on what kind of industry you're going, right? It's enterprise sales, open source. So caveating that with a more generic answer, we would like to see the team and the market first. If you understand if it's the right team, going after the right market, and then trying to understand a little bit more about like who is the person you're going to sell to, or what do they care about? I think then product, and then you go into the tech, and then finally the competition, everything else afterwards, right? But a lot of times people spend the first 10 slides on technology, and that's really interesting, but as a secondary effect, right? First trying to understand, like, do people care? Will they pay for this? And does it work, right? I think going through the sequence and then talking about the AI would be really helpful. But if you're an AI specific company, I think we see too much of like the AI upfront, and that's good. But usually you ask the question like, how is AI helpful? Like it's a tool in a toolbox. It's not the end all.
Mm-hmm. A lot of founders I've talked to seem to have a lot of mental blocks or cognitive dissonance around calculating their total addressable market. For an AI startup, is there anything different or special about calculating TAM, or is it still the same kind of traditional bottom-up approach?
No, I think a lot of times TAMs don't exist in some new spaces, right? I think you need to figure out what can the TAM be if the market forces align, right? I think so. In a lot of cases, when we're in a translation market, we were just talking about this before. The software market for translation is not that big, but then if you take the human capital market, it's $20-30 billion market. So then you look at TAM very differently than if you're selling a software into a translation company, right? So knowing who you're selling to and how you can charge for it will help you address the TAM for a first-time founder. But for us, I think large markets which are attractive and can support margins tend to have better outcomes than maybe large markets which don't have margins, or small markets which can grow into large markets. So there's some markets we stay away from because it doesn't fit the profile for us. But when looking at the TAM, it's good to do a bottoms up and a tops down and just extrapolate to see what makes sense, what doesn't make sense.
Jorge, if you were doing a pitch deck today and you were a first timer working on your TAM slide, who would you show it to before you showed it to Vijay to check your math or make sure you weren't just totally, out over your skis?
I'll show it to as many people as possible. I think that it's more in the order in which you show it to people. I think that investors, also their time is money, right? Like the amount of time that you have in days is limited, and you don't have that many kind of like second, third choice or shot with them. So what you want to do is you want to identify what are your most ideal investors and save that to once you've had feedback from the people that you know are not necessarily your most ideal investors, but they can give you feedback on those very initial things. Because every investor will know if you're, far away from something that makes sense, if you're close to something that makes sense. So to be more precise, don't wait too long to show it to an investor. It's just that there are so many investors out there, and you can always try to start with the ones that are like, well, here I'm just spinning wheels to understand, where the traction is at.
So in the idea stage startup, there is no social proof to validate your idea. We touched on this a little bit, I suppose, but can you give us some granular specifics as far as what are those tangibles? What do they look like when they're actually a market exists for this, even though I don't know what the TAM is? What would that look like for you exactly as an investor?
So I think at the stage we invest in, at least the AI Start Fund, we don't have Gartner top right quadrant startups. There's no Gartner quadrant in most of them, right? We don't have, in some cases, the TAM is not defined yet. The categories are not defined yet, right? And so what we tend to look for is there a buyer out there or a customer enterprise who has a really strong pain point, not a nice to have, must have, and is a startup solving them. And we tend to usually when we do reference calls, we tend to not look at how much revenue the customer is charging or what the sales cycles are, but it's more like how big a pain point was it, and how important
this is the painkiller vitamin mindset.
That's right. And also how valuable is it for that particular user, right? So I think narrowing down on who your target buyer or persona is, and then finding so much value, not 1.5x than incumbents, but 10x. So there's lots of founders who really hone in on that and build a 10x better product, and that's a good validation for us, right? And if it's a larger company and they see a 10x value, that's even better.
It seems as though major AI players are commoditizing different products quickly. If OpenAI updates their product roadmap, that could create an extinction level event for the wrong startup. How are founders addressing this?
So I think we've seen some companies where they are trying to build products which are built on top of other companies' product lines, and there's not enough differentiation if that company they're relying on actually builds that, right? So for example, if you look at Slack or Zoom, they have mass market reach, and so they have distribution, and they have data on which the startup is supposedly building a differentiated product. Now, the question you ask yourself is, what happens if the companies that you're relying on adds a feature which makes logical sense for them, right? And each time Microsoft comes up with a different feature, or Slack or Zoom, a lot of companies have to pivot really quickly, which you could have avoided if you knew that you were in the line of fire. And so I think some founders are really good at understanding that, look, my core strength is in understanding the customer side of things, and I want to go and use this product in a very differentiated setting. That's okay. But if you're just building a consumer product to go against Microsoft Word using an AI bot, and if Microsoft adds that feature within the core product, your business is in an extinction level thing, right? So lots of founders are very good. I think, as Jorge mentioned, we know startups pivot, and that's one of the things we look at is how savvy are they to see market forces and then pivot the business well ahead before it's too late.
So if you are an early stage, if you're a seed stage, idea stage AI startup, how do you dig a strategic moat at that point?
Yeah, I think that the earlier you are, you shouldn't be bought into a solution that strongly, because the solution is likely going to change, such as your understanding of the problem. I think that therefore it is more important to be focusing on, is this the right problem to be solving? Moat is something that starts coming once you get enough data about the problem to then understand, okay, what are the players that are working on this problem, and how am I going to identify, is there a gap here that I can get into and I can be first player? And if I'm not the first player, then how are the people who are solving it that is inefficient and I can solve it 10 times better, 100 times better? But if you don't do that exercise in that order, you may be on the risk of solving a problem that either is not that big, a problem that already has players that can, again, turn you into an obsolete feature if you don't do all this exercise in this kind of like order. So the problem is the most important thing at the very early stage. Moat comes when you understand the problem and you understand the players of the problem and their solutions, and then you understand the gaps. And if there's a gap that allows you to be the first player, then your moat is to be always on the forefront. And if there is no gap, but there's just like very, very bad solutions to the problem, then your moat is that you're 10 times better or 100 times better than what is there to solve the problem.
Are technical founders better off with a non-technical partner?
100%. I think that you will soon realize that a company is a symphony of many different instruments. You don't go to a symphony to hear just one single instrument played by 20 people. You want to guarantee that even if there's like people that have the same instrument, that they're playing different parts. But at some point, you need to add other instruments. Being very aware that a business is a combination of reading the market, going after that market, and then being able to build a product that can deliver. It's a good recipe for success. And also, it's a good recipe to understand that maybe those where there's that kind of like win team where one person has tendencies to be more like driven for business-like operations, and then someone that has a tendency to be more technical and to put together a solution. These stories can repeat themselves. Like Apple is one great example of those, but you keep seeing very successful companies, and even if it's not at the founder state, you will soon that very early these teams add someone that will complement one or the other.
Based on your own personal experience, what you're seeing anecdotally, around how long is the typical fundraising journey these days, from going out into the world with a pitch deck and then going home, celebrating over a term sheet? What are we seeing as far as average timeline, roughly? Or is there an average?
I think it's a very wide range, right? Some companies can raise quickly if they meet the right founder, they have the right product market fit or idea market fit, and it's fairly quick. In some cases, it's longer. I think it's less of a concern if it takes a longer time. It's finding the right partner is more important. So even if it takes you longer, I would suggest looking for the right partner. I mean, partner is not the fund. It's the actual people within the fund also. And it's a huge range within larger funds. There's people you would probably want to partner with. There's people who have completely different philosophy. So I would say like trying to find the right person within that fund is as important as finding the right fund itself. So it's not a race in many ways, but at the seed stage, find the first set of founders who have your back and have the same shared values.
Yeah, I think that one story that someone was telling me that I think that is relevant here is for an investor, the clocks start ticking from the moment that they make the investment. So it doesn't really matter what happened before, in the sense of if it took you some time to get to that point where you're ready. The investor only cares like you're ready now, and from now on, the clock is ticking. Therefore, what they'd be looking at is more like what is the vectors of growth that have accelerated in the past few months. If it took you something before that, a while even to figure this out, it doesn't really matter that much because their capital was not ever like waiting there for something to happen. Therefore, my observations are these deals tend to happen very quickly once things are starting to move very quickly in one vector of growth in your company. Because all of a sudden there's an inflection point that means that you figure out something that makes your opportunity less risky. And therefore, when an investor sees this, they also understand that the opportunity for them has a limited window of time, because if they don't get it, someone else will. And that's the best type of deal. An investor doesn't want to be the only investor interested in a company, because you rarely find gold that nobody else sees.
My last question. So I guess typically for, let's say, a B2B SaaS startup, maybe 18 to 24 months of runway is the recommended. If you were launching an AI startup today in November 2023, how much runway would you want after you closed your first round of funding?
I think that for me, it's important to translate that into risk. So if you think that being concerned about money will deter you from making the right decisions, then you need to raise for the path of money that will guarantee that you can operate mentally. I think that there are entrepreneurs that are okay with like 12-month runways, and they're like, Okay, they're cool as a cucumber. There are other people that then they cannot operate very well when that stress is upon them. So as a decision of risk is more of what will guarantee that you can succeed. If for you succeeding is, I'm okay so long I have 12 months of runway. I'm okay so long I have 24 months of runway. And I think that defines the behavior of a company. You start raising when you're getting closer to that line. It is important that any round that you raise, in my opinion, has to be raised because of an opportunity, not because of necessity. It never goes well. So you have to guarantee that that time frame that you have is not putting you in the necessity for your own personal thing. Again, there are people who are okay with like very short runways. They manage to do it. And that's fine with them. And there are people who are not. So it just really depends on how can you operate a team. And again, when you're early on, you may be okay with this, like 6 months, 12 months, 24 months. But as you start to other people on your team, it is very important for them to know, well, if I'm going to join 6 months down the road, I don't want to be sweating bullets with you. So different stages of a company also make that difference. And it's important to be well capitalized because it gives the people who are going to join you that have the option to join somewhere else as well, great, awareness that they're not going to be stressed for that thing that is not the thing that they signed up for.
Best time to raise capital is when you don't need the money, right? So at the seed stage, there's this notion from founders and VCs that it's a clock. It's like 18 to 24 months you keep raising. It's not, right? I think at the seed stage, you're building a team, you're getting a product to GA, you're selling your first set of products to a customer, and then you realize maybe you have to pivot, right? And so you have to plan for that. So you don't want to burn from get-go because you have an 18-month clock, but you have to burn appropriately to the risk you're taking, right? And most founders don't realize how many times you have to pivot before you get to a product market fit, and that's okay, right? So I think having enough capital to make those pivots and not having to worry about doing bridges, I think it always takes longer than you think to go get that first product market fit. So I think having enough buffer and not being forced to go raise because your peers are going and raising at a faster cadence. And you usually see this, there's 3 or 4 companies, this seems like a race that, hey, if I raise quickly and I keep going, I can grow faster. But you might be growing faster in the wrong direction and maybe going after the wrong customer persona. So I think being deliberate about which market you're going first and then trying to add fuel to the fire once you know is actually a better approach than just raising because you can.
Vijay, Jorge, thank you for a fantastic conversation. I really appreciate the time.
Thanks for having us again.
Yeah, thank you.
I'll be right back with some show notes after a word from our sponsors. Fund to Build Scale is sponsored by Mayfield. If you have a fundable idea for an AI-first startup at the cognitive plumbing layer, email aistart@mayfield.com. The podcast is also sponsored by Security, pioneered the Data Command Center, a centralized platform that enables the safe use of data and Gen AI. To learn more, visit security.ai. Thanks very much to my guests, Jorge Torres of MindsDB and Vijay Reddy of Mayfield. For the next episode, Breaking into Enterprise Sales, I interviewed Maria Latushkin, GVP of Technology and Engineering at Albertsons, and Jack Berkowitz, Chief Data Officer at Security. Maria and Jack are experts in enterprise sales. Both of them have years of experience working inside early-stage startups and buying software for Fortune 250 companies. If you've listened this far, I hope you got something out of the conversation. Subscribe to Fund Build Scale so you'll automatically get future episodes, and consider leaving a review. For now, you can find the Fund Build Scale newsletter on Substack. The theme was written and performed by Michael Tritter and Carlos Chairez. Michael also edited the podcast and provided additional music. Thanks very much for listening.